Good morning. Welcome to Trending Treasury. I'm David Blake. I'm joined today by Amar Jandoo. Thanks to everyone who's tuned in. We can see attendees are a bit lower than usual, but it's half term across the country and quite sunny in some places as well. So yes, colleagues and clients are forgiven for doing other things. It's nice to be able to get out, isn't it? So we're going to be talking about commercial paper and a new short-term funding product we've been working with the Municipal Bond Agency on. So that's the plan for today. Half-hour session. Usual rules. Please do send in your questions. Be great to get some debate and some thoughts from local authorities on the product. So please use the chat box. We are going to be recording this session and posting it on the web. So please be aware of that. That is it. So let's get cracking. I think just before we dive too further into this, the product we have set up at the moment is applicable for English local authorities. We need to work on legal documentation around Welsh, Scottish and Northern Irish clients. So forgive us for focusing on those English clients first of all, but the plan is to expand into those other jurisdictions as time allows. But hopefully you'll still find it interesting and get something out of this. But I'm going to hand over to Amar. We've got a brief set of slides to go through. And yeah, please fire your questions in as they come to you.
Thanks, David, and good morning, everyone. So I thought we'd kick off by looking at some of the key considerations for managing a short-term portfolio. If we go to the first slide, please. Thank you. So when looking at short-term portfolio, we've highlighted some of the key considerations that we should be looking at. So the very first one, which is the obvious one, refinancing risk, which is not being able to replace existing debt with new debt in the future, or that not being at a rate that has been budgeted for. We then have concentration risk. So when we're talking about short-term loans in the local authority universe, this tends to be done on a interlocal authority borrowing capacity, so lending to and from your peers. So although there is significant amounts of liquidity between local authorities, currently at around £13 billion, there are periods of time where this has dried up, the notable one being March 2020, which we saw a significant rise in yields because of the illiquidity in markets. And that was really due to unprecedented times with the onset of the pandemic, but we can't completely rule this out either. So that's where we're at with concentration risk, although I should caveat that with the fact that local authorities do have access to the PWLB as a backstop, where you can borrow short-term at variable rates as well. We've then got yield curve and duration. So what do we mean by that? So local authorities can borrow at very low yields for the short term, generally in the 1 to 6 months is what we see. But as we go longer out on the yield curve, we do see that rates become slightly more expensive. And we'll talk about that a little bit more going forward. And then finally, we've got credit spreads. So of course, the rates that local authorities can borrow on will depend on their credit quality when you are borrowing from markets. So certain authorities that are perhaps doing commercial activity or are locked out of the PWLB for various reasons, their credit spread could be higher than those not doing those things. So they're the key considerations. Going back to concentration risk, I will highlight that on the following slide. So here we are showing local to local market rates. So we have plotted a number of short-term local to local deals, and the red line is SONIA, which we've used here as a benchmark. And that March 2020 spike can be seen quite significantly here, where rates were reached levels up to 2%. Now, as you can see, that was relatively temporary and that came down quite quickly. And where we're trading at the moment is very low and tracking very close to SONIA. But that spike up can't be completely ruled out in the future. So I will pass over to David, who will give us an intro into commercial paper now.
Yeah, thank you, Amar, for setting the scene there. And I suppose just as a bit more background, I mean, we're very comfortable with the local to local market. It's 13 billion pounds plus market. It's deep pool of liquidity there. Particularly at the moment, we're finding there's plenty of offers for cash and perhaps not enough bids on the other side at the moment as grant payments have come in and local authorities are cash rich. So we don't anticipate that pool of funding drying up anytime soon. But it's a question of, well, what if that changes over the next 6 to 12 months? What are the alternatives, and are they worth pursuing? And we think they are. And we think, going back to slide 2, that spike up in rates shows you what can happen when liquidity is squeezed in this market, and the reliance on one type of funder. So we think it is prudent to try and diversify, to try and reach out and tap different pools of liquidity, and that's where commercial paper comes in. So there is this huge pool of short-term, high-quality debt, typically issued by banks, but also by commercials and governments and other institutions. Commercial paper is short-dated, typically highly rated, and allows these organisations to get access to low-cost funding. And on the other side of that, we'll sort of have a look at who the investors are in a moment, but they're typically money market funds, corporates, banks again, governments again. So they're investing and they're looking for safe homes for their cash over a short period of time. So we think, well, can local authorities access this market? And it's something we've been kicking around at Arlington Close for many years. Actually, I've sort of trawled back through our commercial paper directory, and we've sort of revisited this idea on a number of occasions. And actually, one of the main barriers to tapping this market has been the availability and abundance of local to local transactions and the relative ease of that. I think a lot of local authorities know that product, can access it easily, and have been happy doing that. But I think the thing that has changed is we now see more strategic portfolios, so larger holdings of short-term rolling debt at local authorities. We have got, there's one authority that borrows over £1 billion on that basis and rolls it. We have other authorities where it's several £100 million, and even some that going down to the hundreds and fifties, where there is a strategic short-term funding that is rolled over on a regular basis. And we think diversifying sources of funding there could be appropriate, but it hasn't happened to date. There hasn't been that. It hasn't been easy enough, I don't think, to make that happen, for one. And we haven't seen the levels of short-term funding that we now have. So I think they're perhaps the things that have changed that make this viable. So we just show on this chart the gross commercial paper issuance going back over a number of years, and you can see it's well over £15 billion. Typically has been of late. You can also see we do see that issuance spike when there's distress in financial markets, back in 2008-9 during the global financial crisis, and more recently during the COVID pandemic, the early stages of that. A lot of companies, participants needed access to liquidity, and commercial paper is an easy way for them to get that funding in with lower risk to the investors, given the short dated nature. So I should clarify, we're typically talking about less than one year, but not always. So that's the potential market. But the question is, how do you get access to it? How do you tap it? And the barriers we've seen when we've been speaking to participants and banks and dealers and fund managers on this are typically around size. We're typically told that issuance needs to be several £100 million in a single name, which would be a barrier for most, if not all, authorities, really. And typically that entity will need to be rated by at least 2 rating agencies. So you're into sort of bond territory with all the effort that goes with that, and you'll be thinking, hang on, I can just pick up the phone to the broker or go on Ideal Trade and arrange a local to local transaction without going through all that hassle. So so why would I do it? And that's why we haven't seen any movement so far. But we have been speaking to the Municipal Bond Agency about using them as an aggregator to access markets. So the Municipal Bond Agency will set up the framework, the paperwork, the documentation that's debt is issued under, and will also get the credit ratings necessary, and then issue commercial paper to the market and make loans available to individual local authorities. So very much in a similar way to what they propose to do on the long-term bonds and funding. But the key difference being there's no guarantee, there's no cross guarantee in this structure. And we think that's the key point. Once you remove that guarantee and remove the requirement to guarantee, local authority only guarantees their own debt, it becomes a much more compelling proposition as far as we're concerned. So we think that it's a good route to market, and it will be a successful way of tapping into that pool of investors, that pool of ready cash that is available at very short notice. We're originally thinking it will be T+2 for delivery, but that may come even shorter than that later on once the program's established. And it will be an easier way for local authorities to access funding as well, potentially. Given that you just have a phone call into the bond agency, you'll get a market rate, i.e. it'll be benchmarked from SONIA with very little deviation, I would have thought, around that SONIA rate. So you have sort of more visibility on the market. You're less prone to supply and demand dynamics that I think do affect the local to local markets. And we've seen that typically at, not this year end, but other year ends where we have seen rates squeezed, and we do see less supply for longer dates in the local to local market. And actually we'd like local authorities to have longer dated paper. We think they can take out some of that refinancing risk by lengthening the duration of the short-term book, reducing the admin, reducing the number of roles, and providing that diversification effect as well. We're not sort of proposing that everything would be done by this type of product. Indeed, you'd want to keep relationships with your brokers and still use Ideal Trade, or however you access short-term funding as well. And of course, we still have that PWLB short-term loans, variable rate loans as backup if that was required as well. So it's just giving you an extra string to your bow in terms of liquidity management. So let's have a yes, go on, Mar.
What the minimum size be under this sort of structure then?
It was typically going to be £25 million. That's where we benchmarked it to start with. So obviously, clearly, well below where you may have to issue as a single name, which would be a couple of $100 million plus, I would have thought. And the sort of size that we think is marketable in terms of there is that sort of larger local authorities or authorities indeed that just have that more reliance on short-term funding, where they might want to say, actually, yes, we've got 25 million of core short-term funding that we want to get on a more robust basis, perhaps on a more regular basis with less admin at lower rates. And I've got my hieroglyphics type slide here, sort of converted to speaking by emojis, but the first one indicates the diversification effect, so you can effectively speak to many different types of investors using this product. And we think that's the key benefit of this type of product. But we also think it will be more efficient to work this way for some of your funding. It will be easier to get in larger amounts at quite short notice, which is going to cut down the number of calls, the number of transactions, and the amount of admin. But we also believe there's going to be a cost saving as well, because the rates will be benchmarked off SONIA, because rates will, particularly at the longer end, will be probably slightly more beneficial than local to local where we have seen it, and because the transaction fees are going to be lower as well. We think all those things will combine to make quite a compelling product. So that's why we're involved, and we think it's appropriate for those authorities that have the demand. So I sort of anticipated some questions or comments on rates, and I thought it'd be useful to show the slide we have here, where we've got an indication for local authority rates in the 3, 6, 9 and 12-month periods, and they're the durations that we'll be focusing on in the first instance. The rates we compile from the portfolios we see a variety of local authority debt and investment portfolios. We also see where transactions are matched on ideal trade, so we get good visibility on the local to local market. We've added on 7 basis points for brokerage. Clients typically tell us brokerage is in that range of between 5 and 10 basis points, so we've sort of gone in the middle there and added that cost in to give it all in rates shown here. So typically with that upward sloping curve, which is interesting because you do pay more for the longer dated debt, but the curve doesn't necessarily reflect that. You know, although there has been more murmurings of an increase in bank rates at a later stage, you know, not really anticipated over the next year. So we have a very flat SONIA curve, and actually you think, well, you should have a very flat funding curve out to a year as well, and that's not replicated in the local to local markets. Whereas if you look at the indicative rates on a commercial paper-backed loan from the Municipal Bond Agency, you can see their curve is fairly flat. Yes, there's a bit of a tick up for credit supply at the longer end, but it's not nearly so pronounced. And we think there is going to be value in that longer part of the curve, and it fits well with strategic management of short-term portfolios. And so finally, we just thought we'd sum up with, well, you know, sounds great, but how do you get involved? And so there is a bit of a process. Obviously, you know, there's quite a lot to set up here. There's quite a lot working in the background. The actual products to local authorities, short-term loan, is incredibly simple. It's just a short-term loan, so it's low, easy documentation and low commitment, if you like, from a local authority. You know, if you got into this and borrowed for 3 months and didn't like it, or felt the rates were cheaper elsewhere, well, that's going to mature and you can move on. But I think that sort of misses the point. This is more about choice and diversification than necessarily the rate. So but we do need expressions of interest. We've been speaking to a number of local authorities. We've had some very good feedback, actually. I think there is that demand for this type of product now. We speak to a number of authorities that are looking to reduce administration, to take out some of that uncertainty on their refinancing, and look at this slightly different product. So we've already got some good feedback and good expressions of interest from the English local authorities that can apply in the first instance. The credit assessment will apply. Now, credit is easier on commercial paper because from the investor's perspective, it's a short-term commitment. They're not looking to assess the credit of a local authority over 20 to 40 years. They're looking at a less than 12-month time frame where we don't think we're going to see any changes in legislation or how local authorities are governed, or even how they're supported. So it's quite a low risk proposition for an investor from that perspective, which is why the interest rates are so low as well. It is sort of quasi government debts at that short end of the curve, and there's less concern about credit. However, there is still a hurdle at the MBA to get over. Any really weak authorities, or authorities that have very, very high levels of debt, or very, very low levels of reserves, or are in the spotlight in the media for the wrong reasons as well, it's only a handful of those types of authorities that may not make the credit hurdle for the MBA, and then there is a slight requirement to offer the market slightly stronger and less controversial local authority names for the first round of issuance, but that may change over time. But we think most authorities will make that credit assessment. What we can advise on that. And then the next stage will be agreeing terms of engagement, which is our in close support. We're supporting this this initiative. We're doing a lot of the work on aggregating demands and kicking this off with local authorities, also reviewing documentation, ensuring suitability. You need to make sure it's in your approved treasury management strategies as well, and then there's the dealing arrangements, and we're levering off the experience we have running Ideal Trade, where we're matching locals on a regular basis to help deliver this, and that's why we're working in conjunction with the MBA, who now have a fairly limited capacity at the moment, because they're basically run by 2 members of staff, and we're talking to over 180 local authorities on a regular basis, so it sort of makes sense to combine our expertise and theirs, where they have the framework set up and a sort of footprint in the bond market to bring that all together. So that's the reason we're working them, and also because of that change in the guarantee structure as well. We think once you remove that requirement to guarantee peers, this could be a really effective and efficient vehicle. And we're talking about less than 12-month money in the first instance, but we do hope that will grow to perhaps 24 months. So we get 2-year money not long after that. And there is the potential for that to creep along the curve into the 5-year space and beyond, and for locals to get a greater number of interactions with a wider range of financial institutions to drive down funding costs, to make funding cheaper, to make loan rates cheaper, and to spread their refinancing risk and be able to diversify away from the PWLB, which I think is probably attractive anyway, given how policies panned out at the Public Works Loan Board. But we also have some that are reluctant to go to the Public Works Loan Board at the moment anyway, due to their commercial property activities and investments in asset primarily for yield. So they're the sort of thought processes we've been through, and that's what's underpinning this. So we hope the programme will be established over the next 3 to 6 months. That's the timescale. Obviously, we've got summer holidays coming up where everything typically slows down, and just recently we found local authorities quite rightly have their heads in the account, so I'm sure there's some diligently working away looking to get accounts closed down out of the way at the moment as well. So we sort of understand the pressures there, but I think over the next few weeks we hope to sort of fine-tune those expressions of interest and get going on setting up all the gubbins that supports this issuance, with first loans issued towards the autumn, the back end of the year. That's the plan anyway. Amar, have I covered everything? Was there anything I've missed out, or anything you'd like to chip in on?
Well, we've had a number of questions come through actually. Shall I read those out?
Yeah, I can't see them, unfortunately. I'm on the wrong page, but go for it.
Sure. Okay, so how many years can the programme be rolled for is the first question.
Oh, that's a good one. I think rolls are part of the process. You can roll it until the cows come home, basically. As long as there's investor demand, which we'd anticipate there will be, the rolls will be very easy. It will be a question of, right, you've got a maturity coming up. Do you want to roll it, or do you want do you want to return the funds, or do you want to roll it for 3, 6, 9 or 12 months, and where provide support on that functionality. But yes, we're looking for repeats and rolls to support the project. The market wants to see a ready supply of high quality paper, so we don't want to just to come to the market with 50, 100, 250 million and then disappear again. We want to build and grow that program. So rolls are being encouraged and should be low cost and efficient.
Brilliant, thank you. And can the start date be tailored?
Ooh, start dates can, but the durations are going to be fixed. So it is 3, 6, 9, 12 months, but they will be able to start on a tailored basis. So there is some flexibility, but also we need to have some degree of standardization as well. So again, it's something that's where there's going to be more flexibility later on, but the first issuances will be quite simple, and we can get more sophisticated as we go along. Sorry, I found the question. I found the question things now. What else have we got, Amar?
So will council be able to join the programme after the initial launch?
Yeah, definitely. We do need authorities to step up. You know, if everybody waits for someone to test the water and sort of sits on the sidelines watching, then it's not going to work, because we do need those groundbreakers to say, actually, you know, this works for me and I'm going to give it a go. And just on that point, you know, we did have a discussion with a local authority recently about that. We said, well, what's your downside? You know, we've got a very low administration fee to get the ball rolling and shows some commitment to, and then there's no obligation to borrow in that first tranche if it doesn't work for the authority or if circumstances change. And if they do borrow, well, they're just borrowing a very short-term loan for 3, 6 or 9 or 12 months. You know, and if you don't like it, it will mature. So it's very, very low risk. But yes, locals certainly can join after that initial launch, and we'll be looking to do that. And indeed, we're having discussions with some authorities that say that we're sat on a load of cash now. I don't need anything probably before the end of the year, but quite possibly after that we'll be interested. And once it's up and running, it's going to be quite quick to onboard people, onboard authorities.
Thank you. We have had one more, actually, more of a question on the MBA. So this CP program doesn't have the cost guarantee. Do you know anything about whether their other products may change in that form as well?
I think they almost have to, is the honest answer to that, because they just haven't proved popular. I mean, they've been trying to get the joint bonds away for probably 6 years now, which is, you know, that is a fair crack at the whip. I'm not quite sure where they're up to with that. I know there has been a pool of authorities that have been ready to go, but I think, you know, perhaps the more recent financial pressures at local authorities has sort of focused that thought about guaranteeing a proportional amount of someone else's debt, and it's just deeply unpopular. And I think perhaps that's where the agency in its initial setup got it wrong, because it was very focused on delivering a product to investors that worked for them and gave them protections. But they didn't necessarily work for the borrowers. The borrowers didn't want to guarantee their peers. So having said that, we think there's a lot of infrastructure that has been developed at the bond agency that is worthwhile. You know, the membership structure, the fact it's owned by 50 odd local authorities is, you know, again, that's a reason we want to be involved in this. It works well for the sector. There's also the single name issuance that has worked very well for Lancashire and could be repeated for other authorities. And yes, you know, this is effectively short dated, small size single name issuance in a slightly different market. But there's no reason, I don't think, why that couldn't be rolled out at a later stage to other investors in some form. It might take a bit of a tweak. It might require some different thought processes, maybe even some different IT and different methods of accessing. But I think that would be a good step forwards. But I would say it's you know, the issue where you have single names and no joint guarantee or proportionate guarantee, it then becomes an issue of individual credit for that authority, and that hurdle is very easy to overcome for debt of less than 1 year, but it becomes more problematic for longer term loans. That needs extra thought. So would there be requirement for ratings? Would there be you know, further credit assessments that need to take place? But I think on ratings, yeah, there's always been a fear in the sector that ratings are difficult, and getting a credit rating is going to be a difficult process. But I don't actually believe that's the case, and I think that some authorities would benefit from obtaining a credit rating and exploding out the number of funding options that they have available to them. But that's a different webinar, probably, the rating one. But hopefully that's answered Steve's question on that.
Thank you. I have seen the time. We've got a few more questions.
Well, let's keep going, Amar.
Okay. So will the interest rate paid be linked to SONIA or another benchmark?
Ooh. I think it would be very closely aligned with SONIA. I think investors are going to be looking at this and saying, we've already got other benchmarks where we see where high quality corporates issue and other entities that are rated in that AA3, A1 space, where we think the majority of local authorities are also rated, and it is tightly correlated with SONIA. So I think that will be the benchmark. There are some small amounts of supply demand issues on any given day. There may be some small adjustments for credit depending on name. I think they're going to be the main variable factors, but that degree of variation at the short space is, we're talking about 2 or 3 basis points spread around a sort of SONIA benchmark. So it is going to be pretty certain it will be closely correlated with SONIA and those benchmarks. That's our expectations.
Brilliant, thank you. And I might be throwing you in it with this one, but what are the accounting considerations?
Accounting, I think accounting will be very simple. It's a loan, so if you can account for a short-dated loan, interest on maturity, if you can account for a local-to-local transaction, then you'll be able to account for this. It's just a simple loan from the municipal bond agency to a local authority without any cross guarantees or other structures or other things to consider. So we've had a discussion about the accounting in the office, and no problems envisaged there.
Brilliant, thank you. We have had one more actually. The 25 million minimum, is there any chance of that being reduced?
Maybe. I think there is a chance that could happen. First of all, we need to familiarise the market with the product and local authorities, and they will typically want larger sizes to get involved in that. Some of these fund managers are managing hundreds of millions billion-pound portfolios. They're going to want to deal in slightly larger amounts, but investors also like diversification, and if there is an easy way of them accessing smaller amounts, then I think that will be developed and that will be possible, and that is again another ambition and another positive development that can come from this process. That all has to start somewhere, and it will start with the slightly stronger names, slightly larger sizes, slightly standard amounts, and then we'll see where we go from there. But we're quite looking forward to getting that set up. That was a fair few questions there. I think that's it for now, though. I think we've done all right to get 7 questions or so on, given the holidays and the sun is shining. Amar, was there anything that you wanted to add? Was there anything I haven't covered?
I don't think so. I think we've covered everything, but happy to answer any questions that come through after as well. Yeah, and suffice to say, speak to Arlinclo, speak to your usual contact, or drop me or Amar an email or a note if you want more info. But that is it. Enjoy the rest of your day, and we'll be back on Trending Treasury next week, where colleagues will be discussing income strips. So thank you very much. Thank you.